All right, here we go. Here we are. So, welcome to Coffee with Markus. This is episode 130, and today we're going to do something special because today we will do a deep dive into the PowerX strategy. I'll show you exactly why I invented the PowerX strategy and also the exact rules of the strategy so that you can use it in your trading right away. So, let's get started. This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started. All right, so good to see you here. That was the wrong screen. Here we go. So, as I said, today we're doing something special, and here's why. I've been invited to speak at a forum, but with all this coronavirus going on, obviously it's not happening in person, it is virtually. Now, the organizers of this event asked me to record a 1-hour presentation about the PowerX strategy. And this is why I thought, what would be more fun to do it together, because I believe that you can greatly benefit from this as I'm going in detail through the PowerX strategy, right? I mean, what is it? How to set up your charts, when to enter, when to exit, how to place your stop loss. So as you know, I've written this book, the PowerX Strategy. So today I'm basically giving you a 1-hour summary of this book and going into detail. Now here's the deal. Since I need to record this, so this is what I will do here. In just a moment, I'll start the recording. And therefore, I will not be able to look at your questions while I'm doing it. So today's Coffee with Markus, a little bit different, slightly different here. So the main difference, I won't be able to respond to your questions, and we will probably go a little bit longer. So today we will go for, I would say, probably an hour, because this is what they asked me to do. So before we get started, I just want to do a quick check that we can see my handy dandy notepad this way, and also my handy dandy iPad. Perfect. That seems to work really, really well. All right. So this is where Asia, you got to edit out these from now on. So let's get started. All right, welcome everybody. My name is Markus Heitkoetter, and today I want to show you my favorite trading strategy. It's called the PowerX Strategy, and it is a powerful strategy for stocks and options. Now, before we dive into this, let's quickly talk about what is a trading strategy. So what are the questions that a trading strategy needs to answer? Now, the first thing is we need to know what to trade. We also want to know exactly when to enter, and we want to know, let me just move this over here, there, when to exit. And you see, when it comes to exiting, there's two ways as a trader how we can exit. And if everything goes well, it would be with a profit. And I will show you exactly how to do this. But sometimes it won't work out and we have to exit with a loss. So I want to show you exactly where to place a stop loss. What is the ideal loss for a trading strategy? And this is what we're going to do right now. You see, here is one of the challenges that I found with trading strategies. So the challenges of trading strategies are that often they are too complicated. There we go. And often I also found in the beginning of my trading career, when I was looking at some trading strategies, some were too discretionary. And what do I mean by this? Well, for the trader who was presenting the strategy, it all seemed to be so easy, but I could never replicate it because I found that too many trading strategies don't have clear-cut rules of when to enter and when to exit, and also what to trade. Now, let me just clean this up here a little bit to make this super pretty. There we go. Just adding a little bit of color here. So this is where, for me, a trading strategy has to be. And I'm moving this up here a little bit, and I see that it is not completely in sync. Here we go. So a trading strategy for me needs to be easy to understand and execute. And this is what I will show you here in the next few moments. It also needs to be, for me, very mechanical. And by mechanical, I mean that I need to have objective rules, and this is why I like to use indicators. Now, I like to trade what I see and not what I think, right? And this is what this trading strategy does for me. And then my final requirement for a trading strategy is that it needs to have clear entry and exit rules. So there we go. These are my requirements for a strategy, because let me just show you what the challenge was for me before I used this strategy. So I'm going to share my iPad right now, and here you see a chart, right? And I mean, it's always super easy in hindsight to know when to enter, but when to exit. But you see, every single stock, right, doesn't really matter. Even Forex, if you're trading stocks or if you're trading Forex or even cryptocurrencies, there's three ways how it can move. It can either go up, or it can go down, or it can go sideways. Now, here is the key. We want to know exactly when should we buy this stock, when should we sell this stock, and also when should we not trade this stock, right? So this is as important, because during times, there will be times when it is really tricky to trade a stock because it is just chopping up and forth. Now, what I found is that what I'm presenting to you here in the next few minutes, it's universal for really any market. And it doesn't matter whether you're trading stocks in the United States, in Canada, in Europe, in Asia, in China. It really doesn't matter, because again, all stocks have these three directions: up, down, and sideways. So this is why I personally like to use indicators, and I like to use three indicators. Now, here's the beautiful thing. What I'm about to show you exists in any charting software. So it doesn't really matter what charting software you're using. You will find these indicators in any charting software. So let's dive in. The first indicator that I like to use is the so-called RSI. Let me actually jump back to the notepad here for a moment and talk about the indicators that I like to use. So I'm just going to color this a little bit so that it is easier to see. So the first indicator that I like to use is the RSI, the Relative Strength Index, originally developed by Wells Wilder way back. When was it? Maybe 1970 something. And so Wells Wilder suggested that the RSI is an oscillator that oscillates between 0 and 100, and that they're overbought and oversold situations. Now, I personally, for myself, I like to keep it simple. And here is what I like to do. I like to look at the RSI over the past 7 days, and I want to see, is it above 50? Because if so, a stock is more likely to go up. Let's jump on the charts and I'll show you exactly what I mean. So here we go. And again, I'm showing a few annotations here. So we have the RSI here with a close of 7. And I also marked the 50 line right here. So this here is, well, you get the idea, the 50 line. Now, what you will notice is whenever the RSI is above 50, that a stock is more likely to go up. And this is exactly what we are looking for, right? So here we see, for example, that the RSI is above 50 and the stock is going up. Now, right here, we see that the RSI is below 50, right? It is below this line that I have here, and therefore the stock is more likely to go down. Then we're dipping above 50 again, and the stock is more likely to go up. So you see, even just one indicator can help you to determine whether it is more likely for a stock to go up or down. Here's one more example. So here we see that the RSI starts dipping below 50 again. So the stock here is going down. Right here, the RSI is above 50 and we're going up. Simple enough, right? So this is why I love using indicators, because look at this chart. I mean, it pretty much tells us already when the stock is going up, going down, and going sideways. Now, here's what I found in my trading career. I found that sometimes an indicator can give you false signals. And this is why I decide, if one indicator is good, as we already saw with the RSI, what's better than one indicator? Well, two indicators, right? So this is why I added a second indicator, and this is the stochastics. Now, the stochastics is also an oscillator, oscillating between 0 and 100. And again, it is supposed to have some overbought and oversold situations. You see, for me, I like to keep it easy. I like to use the values of 14, 3, and 3, and I want to see that it is above 50. So let me show you exactly what this looks like when we are jumping on the charts. So the next indicator that I want to bring up here are the stochastics. And you see, if I'm just looking at the parameters, there's 3 parameters that the stochastics indicator needs. And here I'm plotting them as 14, 3, and 3. And again, I'm keeping it here super easy, super simple. So let me just take a quick screenshot here so that I can mark on the charts. And here again, we want to see when the stochastics is below 50, like it is right now here, we see that it is more likely for the stock to go down. And when the stochastics is above 50, it is more likely for the stock to go up. Then it dips below 50 again, and it is more likely for the stock to go down. And when it dips above 50 again, it is more likely for the stock to go up. Now, listen, I say more likely because we never know whether a stock will go up with certainty. As traders, all we can do is putting the odds in our favor. And therefore, we are looking for stocks that are more likely to go up, that have momentum, and then we jump on the train. Again, right now we are still talking about when to enter a stock, and a little bit later I will show you exactly when to exit. Now going back to this here, I mean, if one indicator is good and 2 indicators are even better, what is better than 2 indicators? You guessed it, 3 indicators. So this is where I found it is easiest to work with indicators when they are confirming each other. Now you see, in the beginning of my trading career, I tried to find the indicator, the one indicator that is just perfect, right? The one indicator that is right all the time. And I wasted a lot of time on this before I realized it doesn't exist. So this is why these days I'm using 3 different indicators, and they are just confirming each other. So the third indicator that I like to use is the MACD. And the MACD was developed by Gerald Appel. I believe it was also in the 70s or 80s, 1970, 1980. So it's now, 40 or 50 years old, but a very powerful indicator. Now, the MACD is using 3 settings, and here are the settings that you need to use. It's the standard settings of 12, 26, and 9. And here, with the MACD, this is what I'm looking for. If the MACD is above its signal line, this means that a stock is more likely to go up. So again, for all of these, so this here means that a stock is more likely to go up. And when I say stock, I really doesn't matter whether you use a US stock or a Chinese stock or a Forex currency pair or cryptocurrency pairs. It doesn't really matter. So let's jump onto the charts and take a look of what exactly this looks like when we are adding the MACD. So here is the MACD at the very bottom of the charts, and as you can see, let me just zoom in here a little bit so that we can all see it. So the MACD actually, there we go, yeah, has an orange line, which is the signal line, and then we have the purple line, which is the actual MACD. And here's what we see. We see that whenever the MACD, the purple line, is below the orange line, it is more likely for a stock to go down. And whenever the purple line is above the orange line, it is more likely for a stock to go up. Just zoom in. Can you see this here? Right? I mean, super easy, super simple. And then we see again here that the MACD is again, the purple line is going below the orange line. So it is more likely for the stock to go down. And then it goes above the purple line and it is more likely to go up. So how exactly are we using this? Well, this is where, again, I want to see that all of these three indicators are confirming each other. And here's what I do. So I could look down on the charts to see if the indicators are doing it, or I make it easier and actually show it right here on my charts. So what you see here now is that I'm coloring the bars in green and in red. And let me just zoom in a little bit and show you what exactly I'm doing here. Oops. Move over. There we go. Okay. So I'm taking a quick screenshot here so that I can mark on it. And here's what we see. So I'm zooming in. So whenever, right here, the RSI, the first one, is above 50, and the second indicator, the stochastics, is above 50, and the MACD is above the MACD is above its signal line. This is when the market is more likely to go up. How long? Well, the market is going up until we see that at least one of these indicators is dipping. Oops, that's not what I wanted to do. Let's try this again. One of these indicators is dipping below 50 again, right? So if one of these indicators is no longer true, now it means that the market is undecided. Here's another example. Let's take a look at this. So right here, we see that the RSI is now above 50. We see that the stochastics is above 50, and we see that the MACD is above the signal line. So this means that now the market is more likely to go up, or the stock. Until when? Well, it's a short trend, as you can see, but at some point, let me make this a straight line here. There we go. At some point, we see right here that the RSI dips below 50. So how do we use this in our trading? That is the key concept here, right? So whenever we see for the first time that all of these three indicators are lining up on this particular day, this is when we buy. This is when we buy. See, whenever these indicators are lining up for the first time. Now, as you know, we can also, as traders, short the market. We can bet on a falling market. So how exactly are we going to do this? Well, I'm writing this down here in a moment, but basically what we want to see, like right here, this is where we are betting on a falling market. The first time we see that the RSI is below 50 and the stochastics is below 50 and the MACD is below its signal line, this is when we are selling, short selling, to bet on a falling market. So let's make sure that we complete our notes here, because here I had when the RSI is above 50, that is more likely for a stock to go up. When the stochastics is above 50, it is more likely for a stock to go up, and we want to see that the MACD is above it. Now, this is when we turn this around. So this is where we want to see that the RSI is below 50, the stochastics is below 50, and the MACD is below the signal line. That is when a stock is more likely to go down. And this is exactly what you see here on this chart. So this is how exactly we're determining the entry of a market. Now, let's talk about these black bars that you see here. So what happens when we see these black bars? This means that only 2 out of the 3 indicators are pointing in one direction. So here, for example, we see that the RSI is already above 50 in the circle that I marked here, right here, but the stochastics is still below. And if only 2 indicators are true, this is when we are plotting black bars. So, as you can see, by doing this, it is fairly easy to quickly see when a market is more likely to go up, when a market is more likely to go down, and we also see the black bars that sometimes for a market it is more likely to just go sideways, that it hasn't found a direction. So before we move on to exits, is this making sense thus far? I just want to make sure that we are still on the same page, because again, if you're looking at a strategy, so a strategy should tell you exactly when to enter, and in a moment we're going to move on when to exit. But we also want to make sure that a strategy is easy to understand and execute. So what do you think thus far? Is this easy to understand? Can you do this in your charting software? I bet you can, right? It is mechanical, so we want to make sure that we are using indicators. We're doing it. And has very clear entry and exit rules. I mean, yeah, the entry rules are crystal clear, aren't they? Because the entry rules are telling us what exactly needs to happen. There's no room for interpretation, because either the RSI is above 50 or it is not, or it is below 50, right? Or the stochastics is above 50 or it is below 50. Or either the MACD is above the signal line or it is below the signal line. I mean, there's no maybe, whatever, right? It is very clear cut. And this is super important for me as a trader, because this takes the discretion and this takes the guesswork out of trading and makes it super easy, at least for me. Hey, I'm just sharing what works for me, but this is why I needed to have indicators. So now that we have talked about the entries, let's actually talk about exiting a trade. And here's an important concept that I want to show you first. So the most important thing, I believe, for a trader is to limit your losses. Because if you have been trading and you're thinking back over your trading career, what are the losses that are wiping out your account? Is it a lot of small losses, or is it this one big loss? For most traders, it is one big loss that is wiping out a trading account. So this is why one of the most important rules for limiting my losses is the 2% rule. And here is what the 2% rule means. The 2% rule means never risk more than 2% of your account on any given trade. So to show you a few examples, so if you have a $10,000 account and you take this times 2%, it means that you should never risk more than $200. If you have a $5,000 account, so a little bit smaller here, and you're applying the 2% rule, this means that you should never risk more than $100 per trade. And if you have a larger account, let's say you have a $20,000 account, same rule applies, right? Then you would risk $400 for any given trade. So this is the important rule of limiting your risk, and this is what I call the 2% rule. Now, in a moment, I will show you exactly of how this translates into a very specific stop loss. But before we do this, let's also talk about profits, right? Because, I mean, ultimately, we are trading to make money. And you might say, well, Markus, this is nice when you're talking about losses. I don't want to have any losses. And that's cute, because you see, losses are part of our journey as a trader. Losses will happen. The key is to keep your losses small. But hey, let's talk about taking profits. And this is a super important concept, that took me a while to understand. So taking profits while they are there. Because you see, these days, profits can disappear really, really quickly. Let's go back to this chart. I mean, let's take a look at this here. If you just look at this particular stock that I picked for this example here, we see that there are no trends that are going on forever. At some point, this trend is over. At some point, this trend is over. At some point, this trend is over. So we need to find a way not to only know when is it over, but also when to take profits. There's my handwriting. Congratulations. Okay. Anyhow, so let's talk about this. And here is, for me personally, the easiest way that I found to take profits. And it is what I call the golden rule. And here's what the golden rule means. The golden rule means 1 to 2. What the heck does this mean? Well, let me just explain this to you, what this golden rule means. The golden rule means that you take 2 times the amount you risk as profits. So, going back to our example here, if we are risking $200, so if you risk $200, this means that you would take profits as soon as you see $400 in profits. And see, this might sound boring because as traders, we want to have this one trade that makes us 10 times our money. We want this trade that turns $1,000 into $10,000, or that turns $1,000 into $100,000. And even though these trades might exist, I found that they are not consistent in the market. And you see, for me, as a trader who is trading for income, who is trading for a living, it is important that my profits are predictable. And this is why I call them SRC profits. And I just want to write this down here. So SRC profits, and this stands for S is systematic. So not just, let's just take profit. Fritz, it's also repeatable, that I can keep doing this over and over and over again, every week, every month, every year. And finally, for me, it is important that these profits are consistent. Now, here is the super, super cool thing. When you apply the golden rule, you can be wrong half of the time and still make money. What? How is that possible? Being wrong half of the time and still make money? Well, let me show this to you. We use this as an example here. So let's say that we are putting on a total of 10 trades. And out of these 10 trades, we have 5 losing trades. So half of our trades are losses. Now, how much do we lose on each losing trade? Well, we're risking $200 per trade. So on 5 losing trades, we lose minus $1,000. 5 times 200. Now, on the other hand, we have 5 winning trades. And how much do we make on a winning trade? Well, our goal is to make $400 on a winning trade. So 5 winning trades, if we succeed, this would be $2,000. So after 10 trades, how much profit do you have left, right? So after 10 trades, you still make $1,000, right? You lose $1,000, but you make $2,000, so you're ahead of the game. So isn't that great? So this is why, and I'll show you in a moment how exactly we're going to do this on the charts. But it is super important that you understand the concepts, and the key concepts here are really the 2% rule. Never risk more than 2% of your account on any given trade, and the golden rule. you take twice the amount that you risk as profits. Now, very, very important. This here are the rules for the PowerX strategy, because that's what I'm talking about right now. When you trade another strategy, it might be different, but for the PowerX strategy, these are the rules, and this is what I promised you, that here in the time that we are spending together, I'm showing you a strategy in detail. So, how does this translate into a very specific stop loss and profit target? So this is where I want to write down how to calculate your stop loss and profit target. So, and that's what we're going to talk about right now. So a concept that I like to use for calculating a stop loss and a profit target is the concept of the ADR. And here's what it means. The ADR means the average daily range. And this means how much on average does a stock move from the high of the day to the low of the day over the past 7 days. So this here is over the past 7 days. And let's jump back to the chart so that I can show you exactly what this looks like. So here we are on the charts, and I plotted the ADR at the very, very bottom. And I want to zoom in so that you can see it a little bit better, because I understand that it might not be easy to see. So here we go. The ADR for this particular stock right now is 40 cents. What does it mean? It means that on average, over the past 7 days, this stock moved 40 cents from the high to the low. So, and this is what we see here. So how do we use this information? How does this make sense at all? Well, I like to use this average daily range as a stop loss. So if right now, as you can see, this stock is trading at $8.11, if I wanted to enter the stock right now, so if I would see the first green bar where it is going up, if I wanted to see this, and if I wanted to enter, I would actually place my stop loss 40 cents below the market. So I would take the $8.11 minus 40 cents, which is $7.72. So let me just remove a few things, because this would mean, actually, you know what? Let's write this down here really quick. So we calculate the average daily range, and then for our stop loss, we use 1 times the ADR. So in our example, it was 40 cents. Meaning that if our entry is $8.11, we would calculate our stop loss as $8.11 minus 1 times the ADR. So this would be $7.72. This making sense thus far? Let's jump on the charts and see what exactly this would look like. So here I'm bringing up the charts, okay, and I'm zooming in a little bit. So if we would just enter right here, which again we wouldn't, because we're waiting for what? A green bar. And right now, what is this bar? Black, right? And what do we do on a black bar? We sit on our hands and twiddle our thumbs and don't do anything. But just for this example, so we would enter here, and then our stop loss would be right here at $7.72. 772. Now, on the other hand, right? Where do we place our profit target? And this is where we go back to our principle. We already know that our profit target is what? It is 2 times the stop loss. And if our stop loss is 1 times the ADR, it means that 2 times the ADR would be our profit target. So again, we're assuming that our entry is at $8.11. So our profit target here would be $8.11 plus 2 times the ADR, which is 2 times 40 cents. So this would be 80 cents. Therefore, our profit target is at $8.89. Let's go back to the chart and just take a quick look at this. So all we want this stock to do is, as you can see, going up to pretty much this level here, $8.89. Not a whole lot. And now you might say, oh my gosh, Markus, what are you doing here? This stock could go to $10, $11. It could go to $20. And you know what? It could, or it could turn around. Keep this in mind. Nobody ever got broke taking profits. Let's write this down because it is so important, right? Nobody ever got broke taking profits. It's not broker, it's broke. Let's highlight this in yellow because it's really, really, really important, right? So, because as you have seen, I wanted to highlight this in yellow. As you have seen, if we can do this, if we can make twice as much on our winning trades than we lose on our losing trades, then we actually can make money even if we are wrong half of the time. We still make money. Now, obviously, the indicators that we use here are giving us an edge. So with these indicators, we are putting the odds in the favor, and we are already jumping on a market that is showing momentum, a market that is actually going up, or a market that is going down if we like to short bet on a market. So as you can see, this here is a super systematic approach, very mechanical because we are using indicators. Now, one thing that I want to show you here, almost in closing, but it is very, very important, is how do these 40 cents tie into the $200? Because didn't we just talk about this, that we wanted to risk $200? Absolutely. So let's talk about stop loss and position sizing. And this is another super important aspect of trading that many, many traders are getting wrong. So you saw that we calculated our stop loss based on the ADR, and we said the stop loss per one share is 40 cents. So this is 40 cents per share. But the overall risk is that we want to risk is $200, and this would be based on a $10,000 account. So how do we do this, right? How exactly does this work? If our stop loss is 40 cents per one share, and we want to risk a total of $200 on the overall trade. Well, this is where position sizing comes in. So this is where now we talk about the position size, and the position size basically means how many shares should we trade. And this is where it is super easy. We're taking the overall risk and we're dividing this by the stop loss. So here in our example, we're taking the $400, dividing this by 40 cents, and this means that we should trade 200. There we go. 200, and in order to make sure that I'm not doing any stage math here, we're taking the 200 divided by 40 cents, and this means that we should trade here 500 shares. So here is the really, really, really cool thing. Because, oops, that's not what I wanted to do. Here we go. Using the ADR, it automatically adjusts our stop loss based on the stock price. Let me show you another very specific example. And for this example, I want to use, let's just use a stock that is wildly popular right now, which is Tesla. So let me just pick Tesla here. And as you know, Tesla is a stock that is much more expensive than the stock that I've shown you here. However, the exact same rules apply. So let's take a look at Tesla here. I actually want to zoom in a little bit so that we can all see it. Right now, as I'm recording it, Tesla is trading at $850. Subject to change because, as we know, Tesla is trading wildly. So if you're watching this a few days after I'm recording it, or a few weeks, Tesla might be at 2,000 or might have crashed and burned and is trading at 400. Who knows? Here is the important principle. We are taking a look at the ADR, and the ADR for Tesla is $32. To be exact, it's $32.03. So this means that our stop loss in this case is $32. So if we would buy Tesla, if our entry is $850, we would place our stop loss $32 below, and this is $828. This is where our stop loss would be. So our profit target, as you know, is twice our stop loss, so it would be $64. And this means that if our entry is $850, we would take it plus $64, meaning that at $914, we would get out of there. Now let's talk about stop loss and position sizing. So here, in the next example, we are using the example of Tesla. TSLA is the symbol. So here, it is slightly different, and you see how many stocks we could trade. So here, our stop loss, based on the ADR, is $32 per share. Okay? And again, the overall risk hasn't changed. If we have a $10,000 account, right, we don't want to trade more, don't want to risk more than $200. And again, this is based on a $10,000 account. Okay, so now the question is, in this example, the position size, how many shares of Tesla should we trade? And again, super easy. We're taking the overall risk and we're dividing this by the stop loss. So here in this case, we are using the $200 that we want to risk and divide it by $32 per share. And we bring up our handy dandy calculator and we take the 200, divide this by 32. So here it would be 6.25 shares. Now we round this down, so we would trade 6 shares of Tesla. You see the difference between trading 500 shares and trading 6 shares? And this is really so important when trading. Because most people might say, yeah, you know what, I trade 10 shares of Tesla, and I trade 100 shares of Apple, and I trade 1 share of Amazon, and I trade 5 shares of Netflix. Right here, you're having a scientific formula to know exactly how many shares you should trade. And that is the super cool thing. See, for a stock that is less expensive than in the example that I've shown you, so here, we were looking at an $8 stock, right? So this here is an $8 stock. We are risking 40 cents per share. If we have a larger stock for Tesla trading at $850, we are risking $32 per share. So the beautiful thing here is with this methodology that using this ADR, it automatically adjusts itself for a market that is ever changing. Because if we look back at Tesla, and let me just get rid of this, and we see that Tesla a few months ago has been trading, let me just reset my chart here. There we go. So let's just look at this here, where Tesla just a few months ago has been trading at around 200. Let me just make sure that I can draw a straight line here. There we go. So what would happen at this time? If we are looking at the ADR at this time, we see that the ADR was completely different. In fact, let's actually zoom in and let's see what happened when Tesla was trading at 200. Where was the ADR at this point? So here we see, as we're zooming in here a little bit, and as Tesla is trading around 200, the ADR was only $9.11. So this means, right, if Tesla is trading at a much lower level, that our stop loss is no longer $32, but our stop loss now is, what did we say? $9, right? So therefore, if our entry, and I'm using here the example of 215 is $215, our stop loss would be at $206. And our profit target would be at 215 plus two times the average daily range, 18. So this is 233. So as you can see, we have a completely different number here. Now, going back to the example here, this is where the magic happens. So here we use an example of Tesla when it was trading at $200. So here our stop loss based on the ADR was $9 per share. And again, we can do our calculations, and this here was the example of Tesla at 850. Oops, there we go. Okay, so here, how many shares would we trade if Tesla would trade at 200? Again, by the time you're watching it, who knows? Tesla might have crashed down to 200 or it might be at 2000. With Tesla, you never know. So here we would take the 200 overall risk divided by stop loss, still the same principle. And this is where, let's bring up our handy dandy calculator that says 200 divided by 9. So here we're talking about 22 shares. So as you can see, the beautiful thing is by using the ADR that it automatically adjusts our stop loss, right, based on how volatile a stock is, and the position size, how many shares we should trade. So let's just summarize what we have learned thus far and see where we are right now. So we started off this presentation 45 minutes ago by saying, okay, we need a trading strategy that tells us what to trade, when to enter, and when to exit. And we wanted to know when to exit with the profit and when to exit with the stop loss. We knew that many trading strategies are too complicated, too discretionaries, or don't have clear-cut rules. So our mission going into this presentation was to find a strategy that is easy to understand and execute, that is mechanical and has very clear entry and exit rules. For our entries, we used indicators, and we used the RSI, the stochastics, and the MACD. I want to see that all three indicators are confirming each other, and that if all three indicators are true, it is more likely for the stock to go up. On the other hand, if the RSI is below 50, if the RSI is below, the stochastics is below 50, and the MACD is below its signal line, it is more likely to go down. And we want to enter on the first day when this happens. And in order to make our life a little bit easier, and I'm jumping back here on the charts in just a moment. Just wanted to change it back to the original chart that we were on when we were using the example. So here is where we said, okay, we make our life a little bit easier. There we go. And color our bars in green when all these 3 criteria have been true. And we color it in red when these criteria for a downtrend have been true. Now, after we know when to enter, we also need to know when to exit a trade. We talked about how to limit your losses by using the 2% rule. We also talked about how to take profits, because you want to take profits while they are there by using the golden rule, meaning that we take twice the amount that we risk as profits. And we said by doing so, by applying the golden rule, we can be wrong half of the time and still make money. And I've given you a very specific example here. That's when we used our mechanical approach for systematic, repeatable, and consistent profits, for SRC profits. And we calculated our stop loss by using a very super easy, simple mathematical formula, by using the average daily range. Our stop loss is 1 times the average daily range, and our profit target is twice as big as our stop loss, because nobody ever got broke taking profits. And then we did specific examples where we see that our position size, meaning how many shares we should trade, is dependent on the volatility of the stock. And the volatility of the stock often depends on the stock price. So we did an example for a stock that was around $8. We did an example for a stock that is trading at $850. And we did an example for a stock that is trading at $200. So here, there you go. Now you have a powerful trading strategy for trading stocks and options with very specific rules of when to enter, when to exit with a profit, and when to exit with a stop loss. Well, I hope that you enjoyed watching this presentation as much as I enjoyed making it for you. And I hope that you can use this in your trading right away and then make money. Because as traders, ultimately, that's what we want. We want to find a way to systematically, repeatably, and consistently to make money in the markets. And this is one way to do this. Hope you enjoyed the presentation. My name is Markus Heitkoetter. Thank you so much for watching this presentation. I hope to see you sometime very soon. Take care, everybody. All right. Well, we're a little bit less than an hour, so this should have taken us 50 minutes. And I know that for those of you who are here watching live, today I have not been able to take a look at the comments. Coffee with Markus is usually more interactive, but as said, today I had to record a presentation for somebody who invited me to their event, and since they can't do the event live, they wanted me to record this presentation, and there you go. And I hope that this helps you in your trading. When we come back in the next Coffee with Markus, we'll take a look at my $500,000 account and see, am I achieving my goal of making $15,000 per month? That is my goal, right? To trade for a living, because I estimate my living expenses to be around $15,000 and still have to calculate it exactly, but I think we should be here on the good side. So the idea here is to make at least $500 a day, and this is what we're going to take a look in the next Coffee with Markus. So subscribe to this channel, and if you enjoyed this presentation, click on like, and I will see you in the next Coffee with Markus, where I'll show you another trading strategy that I like to trade, because I like to trade 2 different strategies: the PowerX strategy that you now know, and I like to also trade the wheel strategy, and we'll talk more about this in the next Coffee with Markus. Until then, have a fantastic rest of your day, and I'll see you soon. Take care.